Hey, welcome back to the channel. Today, we're checking out KPIT Technologies. This one's been getting a lot of buzz lately, especially because of its strong focus on automotive software, electric vehicles, and self-driving tech. But the real question is KPIT a good value buy, or is it already too pricey? Let's find out. So, KPIT is basically a global software company that works mainly in the mobility and automotive space. Unlike other IT firms that do a bit of everything, KPIT has carved out a special niche. They're building software for electric cars, autonomous vehicles, connected mobility, and digital dashboards. All of these are huge trends shaping the future of cars. Now, coming to numbers, in the first quarter of this financial year, KPIT's revenue grew by almost 10% compared to last year, which is good. But their profit after tax is down by about 16% since costs grew faster than revenue. Profit per share for the quarter is around 6.3. Despite this short-term pressure on margins, if you look at the big picture, KPIT has done really well over the last 5 years with profit growing at nearly 40% annually. Plus, their return on equity is strong at about 30%. And probably the best part, the company doesn't have much debt, which is a huge plus for financial stability. Talking about valuation, here's where things get interesting for value investors. The stock's price-to-earnings ratio is around 42.5, which is higher than most of its IT peers. The price-to-book ratio is about 12, meaning it's trading way above its actual book value. And the PEG ratio is around 1.15, which shows the market expects the company to keep growing fast. So basically, the stock is expensive, and any slowdown in growth could lead to a sharp drop. On the dividend front, KPIT is pretty shareholder-friendly. Last year, the company paid out about 85% of its earnings as dividends, with a 25% interim and 60% final dividend. The yield is just about 0.7%. Not much for income investors, but it does show management's confidence in rewarding shareholders consistently. So why should a value investor consider KPIT? First, it's right in the middle of the biggest growth themes like EVs, driverless cars, and connected vehicles. It has a clean balance sheet with no debt, a strong return on equity, consistent profit growth, and a decent dividend track record. But of course, there are risks too. The stock valuation is already high, so it's priced for perfection. Margins are under pressure because costs are going up. And since KPIT's business depends on the automotive cycle, any slowdown in global auto demand could also hit the company. In the end, KPIT is a very good business with solid growth drivers and sound financials, but it's not cheap. For investors with a long-term view, it could be a strong compounder if growth continues. But if you're strictly a value investor looking for cheap valuations, it might be better to wait for a correction or an opportunity to buy at a lower price. So, what's your take? Are you ready to buy KPIT at this premium, or would you prefer to wait? Drop your thoughts in the comments. And remember, this video is just for learning. Always do your own research before making any investment decisions. If you liked this video, please hit like, share it with your friends, and subscribe for more detailed stock analysis. Thanks for watching.